I need to tell you something urgent, something that most investors are completely missing right now in December of 2025. We're at one of those rare moments in the market where several extraordinary opportunities are available at the same time, but the window's closing fast. Within the next few weeks, maybe months, these opportunities will disappear. Prices will adjust, the market will wake up, and investors who waited will have missed their chance. I don't say this often. I'm not someone who creates false urgency or tries to get people to panic into investments. I've been investing for over 80 years, and I can count on one hand the number of times I've felt this strongly that we're at a critical moment. This is one of those times, and today I'm going to tell you exactly which stocks you need to buy before this window closes, and more importantly, why December of 2025 represents the last chance to buy them at these prices. But before I tell you which stocks I'm talking about, let me explain what's creating this opportunity. Because if you understand the forces at work, you'll understand why I'm so confident that these prices won't last. We're in a unique moment where three major factors are converging. First, interest rates have peaked and are starting to come down. The Federal Reserve raised rates aggressively in 2022 and 2023 to fight inflation. They took rates from near zero to over 5%. That was the fastest rate increase in 40 years. And it worked. Inflation has come down dramatically. We're now back near the Fed's 2% target. So the Fed has started cutting rates. They cut in September, and they'll likely cut more in early 2026. Why does this matter? Because when interest rates fall, stocks become more attractive. Think about it this way. If you can get 5% risk-free in a Treasury bill, stocks need to offer meaningfully higher returns to be attractive. But if Treasury bills only yield 3%, suddenly stocks paying 4 or 5% dividends look very appealing. Lower interest rates also make it cheaper for companies to borrow money to grow their businesses. And they make future earnings more valuable in present value terms. So falling interest rates are a tailwind for stock prices. Second, we're entering what I believe will be a strong economic period in 2026 and beyond. The economy has been remarkably resilient. Despite all the predictions of recession, despite the aggressive rate hikes, the U.S. economy has kept growing. Unemployment is low. Consumers are spending. Corporate profits are strong. And now, with interest rates coming down, businesses that had put investments on hold are starting to invest again. I'm seeing this in the businesses that Berkshire Hathaway owns. Our manufacturing companies are getting more orders. Our retail businesses are seeing solid traffic. Our energy businesses are investing in new capacity. This tells me that the economy has real momentum, and that momentum will likely accelerate as rates fall and borrowing becomes cheaper. A strong economy is good for corporate profits, and corporate profits drive stock prices over time. Third, and this is the key point, the stocks I'm going to tell you about are currently undervalued, not slightly undervalued, significantly undervalued. The market has been focused on technology stocks, especially artificial intelligence companies. Money has poured into a handful of mega cap tech stocks while other sectors have been neglected. This has created pockets of real value in areas that the market is ignoring. And I'm seeing valuations that remind me of periods in the past when we had extraordinary buying opportunities. So we have falling interest rates, a strengthening economy, and pockets of significant undervaluation. These three factors together create what I call a perfect storm for certain investments. But here's why December of 2025 is critical. Once the market fully processes what's happening, once investors realize that rates are coming down and the economy is strengthening, money will flood back into these undervalued sectors. Prices will adjust rapidly. What's trading at 12 times earnings today might be trading at 18 times earnings in 6 months. What's yielding 5% today might be yielding 3% as the stock price rises. These opportunities won't last. They never do. When the market identifies value, it moves quickly to exploit it. So if you want to benefit from this setup, you need to act now, not next quarter, not next year, now. Let me tell you about the specific stocks and sectors where I'm seeing the most compelling opportunities. The first area I'm extremely bullish on is regional banks. Specifically, I'm talking about well-run regional banks with strong deposit bases, conservative lending practices, and attractive valuations. Why regional banks? Because they've been absolutely destroyed over the past 2 years, and the damage is not justified by the fundamentals. Let me explain what happened. In March of 2023, Silicon Valley Bank failed. Then Signature Bank failed. Then First Republic failed. These failures created panic about the entire regional banking sector. Investors assumed that all regional banks were in trouble. They assumed that deposit flight would spread. They assumed that unrealized losses on bond portfolios would force more banks to fail. And the stock prices of regional banks collapsed. Some of them fell 50 to 70%. But here's what actually happened. The panic was overblown. Yes, a few banks that had terrible risk management failed. But the vast majority of regional banks were fine. They had diversified deposit bases. They had conservative loan portfolios. They had adequate capital. And they weathered the storm. Fast forward to today, December of 2025, and the regional banking sector has stabilized. Deposits have stabilized. Credit quality remains strong. Banks are profitable, but the stock prices haven't recovered. Many regional banks are still trading at 8 to 12 times earnings. Some are trading below tangible book value. That's absurd. Let me tell you about a specific bank I'm very interested in. I won't name it because I don't want to move the market, but I'll describe the characteristics. This is a regional bank with about $100 billion in assets. They're based in the Southeast. They have a fortress balance sheet with very strong capital ratios. Their loan portfolio is conservatively underwritten with low default rates. They have sticky deposits from small businesses and consumers. They're not dependent on hot money from crypto startups or venture or capital firms. And they're trading at 9 times earnings with a 4% dividend yield. 9 times earnings. For a bank that's profitable, well-run, and has a strong competitive position in a growing region, that's crazy cheap. Why is it so cheap? Because the market is still scared of regional banks. Because money has flowed into the mega cap stocks and out of regional banks. Because investors have short memories and can only focus on what's hot right now. But this won't last. As interest rates come down, banks' profitability will improve. They'll be able to compete more effectively for deposits without paying sky-high rates. Their bond portfolios will recover value, and the market will realize that regional banks are not going to fail. They're going to thrive. When that happens, this stock trading at 9 times earnings could easily trade at 14 or 15 times earnings, which is still below historical averages. That's a 50 to 60% upside from current prices. Plus, you're collecting a 4% dividend while you wait. That's an outstanding risk reward. Now, I need to be clear. Not all regional banks are good investments. Some made bad loans. Some have concentrated exposure to commercial real estate. Some have weak management. You need to be selective. But the high-quality regional banks with strong fundamentals are trading at valuations that we may never see again. This is a once-in-a-decade opportunity in the banking sector. And December of 2025 is your last chance to buy at these prices, because I believe that by mid-2026, 26, the market will have repriced these banks significantly higher. Interest rate cuts will have boosted their profitability. The fear from the 2023 bank failures will have faded, and investors will be scrambling to buy banks that are trading at 9 times earnings and yielding 4%. But they'll be trading at 13 or 14 times earnings by then. The opportunity will be gone. The second area where I'm seeing extraordinary value is energy stocks, specifically integrated oil and gas companies with upstream production, downstream refining, and strong balance sheets. These companies have been out of favor for years. Environmental concerns, ESG investing mandates, and the push toward renewable energy have driven capital away from traditional energy stocks. Many institutional investors won't even consider buying oil companies. This has created a situation where some of the best businesses in the world are trading at absurdly low valuations. Let me give you some numbers. There are major integrated oil companies trading at 6 to 8 times earnings, 6 to 8 times. These are companies generating tens of billions of dollars in free cash flow, companies with oil and gas reserves that will generate cash for decades, companies that are returning massive amounts of cash to shareholders through dividends and buybacks, and they're trading at 6 to 8 times earnings. Why? Because the market assumes that oil demand will collapse as electric vehicles take over, because the market assumes that these companies are in terminal decline, because ESG funds won't touch them. But here's what the market is missing. Oil demand is not collapsing. Yes, electric vehicles are growing. Yes, renewable energy is expanding, but the world still needs enormous amounts of oil and gas. We need it for transportation, for plastics, for chemicals, for heating, for industrial processes. Global oil demand is still growing, not shrinking. Let me share some facts that most investors don't know. In 2024, global oil demand reached about 102 million barrels per day. That's an all-time high. And the International Energy Agency projects the demand will keep growing until at least 2030, reaching 106 million barrels per day. So despite all the talk about energy transition, despite the growth in electric vehicles, oil demand is increasing. Why? Because developing countries are industrializing, because billions of people are entering the middle class and buying cars and using energy, because population is still growing. The energy transition will take decades. It won't happen overnight. In the meantime, the world needs oil. And here's the critical point. The oil industry has dramatically underinvested in new production over the past 5 years because of ESG pressure, because of investor hostility, because of government policies discouraging fossil fuels. Oil companies have cut back on exploration and development. They're not drilling as many new wells. They're not developing new fields. This means that as existing wells decline, and all oil wells decline over time, there won't be enough new supply to replace them. What happens when demand keeps growing, but supply growth slows, prices go up? We're already seeing this. Oil prices have been volatile, but they've generally stayed in the $80 to $90 per barrel range. That's profitable for oil companies. And I believe that oil prices will remain elevated because supply will be constrained. So we have a situation where oil companies are generating enormous free cash flows at current oil prices. They're returning that cash to shareholders. They're strengthening their balance sheets. They're buying back stock at cheap prices. And the market is valuing them as if they're going out of business. This is an incredible opportunity. Let me describe the type of oil company I'm most interested in. I want an integrated company with both upstream production and downstream refining. Why integrated? Because when oil prices are high, the upstream production is very profitable. When oil prices are low, the downstream refining margins often improve because input costs are lower. This provides some natural hedging. I want a company with low-cost production. Some oil companies can produce oil profitably at $30 or $40 per barrel. Others need $70 or $80 to break even. I want the low-cost producers because they're profitable in any oil price environment. I want a company with a strong balance sheet and moderate debt. Some oil companies are over-leveraged. If oil prices fall, they get in trouble. I want companies that can survive and thrive in any oil price scenario. And I want a company that's returning cash to shareholders. The best oil companies right now are paying dividends of 4 to 6% and buying back stock aggressively. Over time, this creates enormous value for shareholders. There are several companies that meet these criteria, and they're trading at 6 to 8 times earnings. Some are trading at valuations that imply oil prices will fall to $40 or $50 per barrel and stay there permanently. That's not going to happen. $40 oil doesn't provide enough incentive for companies to invest in new production, so supply would fall, which would push prices back up. The oil market self-corrects. When prices are too low, supply falls until prices rise. When prices are too high, demand falls and supply increases until prices come down. Over the long term, oil prices need to be high enough to incentivize adequate investment in new supply. I believe that's somewhere in the $70 to $90 range. At those prices, the integrated oil companies I'm describing will continue to generate massive free cash flows. And as they buy back stock at 6 to 8 times earnings, they're creating tremendous value. Let's do some math. If an oil company is earning $10 per share and the stock trades at $60, that's 6 times earnings. If they generate $12 per share in free cash flow and they use $8 per share to buy back stock, they're reducing the share count by over 13% per year. In 5 years, they'll have reduced the share count by over 50%, so the earnings per share will nearly double, even if the total company earnings stay flat. And the stock price will have to adjust higher to reflect that. This is the magic of buying stock at cheap valuations when the company is using its cash flow to repurchase shares. The math works powerfully in your favor. But here's why December of 2025 is critical. As interest rates fall, income-seeking investors will start looking at dividend yields. Right now, they can get 5% in cash. So a stock yielding 4% isn't that attractive. But when cash yields 2 or 3%, suddenly a stock yielding 4 to 6% looks very attractive. Money will flow back into dividend-paying stocks, including energy companies. Also, as the economy strengthens in 2026, oil demand will accelerate. This will support oil prices and possibly push them higher. And the market will start to recognize that oil companies are not going away. They're cash-generating machines that are dramatically undervalued. When that recognition happens, these stocks will re-rate higher. A stock trading at 6 times earnings could easily trade at 10 or 11 times earnings. That's a 60 to 80% gain. Plus you're collecting a 4 to 6% dividend. This is one of the best opportunities I'm seeing in the market right now. But you need to act in December of 2025 because I don't think these valuations will last into 2026. The third area where I'm extremely bullish is certain healthcare stocks, specifically pharmaceutical companies and medical device companies with strong pipelines, durable competitive advantages, and attractive valuations. Healthcare has been out of favor because of political concerns about drug pricing, because of ESG-related controversies, and because money has flowed into sexier sectors like technology. This has created real value in healthcare. Let me focus on pharmaceutical companies first. There are major pharmaceutical companies trading at 12 to 15 times earnings. These are companies with blockbuster drugs generating billions in revenue. These are companies with strong pipelines of new drugs in development. These are companies with decades of expertise in drug discovery and development, and they're trading at 12 to 15 times earnings with dividend yields of 3 to 4%. Why so? Cheap, because the market worries about patent cliffs. Every drug eventually loses patent protection and faces generic competition. So investors worry that today's profits will disappear when patents expire, but this concern is overblown. Yes, individual drugs lose patent protection, but good pharmaceutical companies have pipelines of new drugs to replace the ones that go off patent. It's a continuous cycle of innovation. Some new drugs succeed, some fail, but the successful ones generate enough profit to more than compensate for the ones that go off patent. Let me describe the type of pharmaceutical company I'm interested in. I want a company with multiple blockbuster drugs, not just one. Diversification across several major drugs reduces the risk that any single patent expiration will devastate the company. I want a company with a strong pipeline. They should have drugs in late-stage clinical trials that have a reasonable probability of approval. These pipeline drugs will drive future growth. I want a company with expertise in difficult therapeutic areas. Some diseases are harder to treat than others. Companies that can successfully develop drugs for difficult diseases have real competitive advantages. And I want a company with a strong balance sheet and high profit margins. Pharmaceutical companies with strong margins can afford to invest heavily in research and development, which creates the next generation of blockbuster drugs. There are companies that meet all these criteria, and they're trading at 12 to 14 times earnings. That's cheap for businesses that are highly profitable, that have strong competitive positions, and that have long runways for growth. Why am I so confident in pharmaceutical companies? Because the fundamentals are incredibly strong. The world's population is aging. Older people use more health care and more medications. The middle class is expanding in developing countries. As people get wealthier, they spend more on health care. And medical technology keeps advancing. We're developing better drugs for cancer, for Alzheimer's, for diabetes, for heart disease. These advances create enormous value for patients and generate substantial profits for the companies that develop them. The pharmaceutical industry is not going away. It's growing. And the best companies will continue to earn high returns on capital, but they're being valued as if their growth is over. That creates opportunity. Now, let me talk about medical device companies. These are companies that make surgical equipment, diagnostic devices, implantable devices like pacemakers and hip replacements. Medical device companies have several advantages. They're less politically controversial than drug companies. People don't get as upset about the cost of a pacemaker as they do about the cost of a drug. They have high switching costs. Once a surgeon is trained on a particular surgical system, they're reluctant to switch to a competitor system. Once a hospital has standardized on certain equipment, they're reluctant to change. And they benefit from the same demographic trends as pharmaceutical companies. Aging populations need more surgeries, more implants, more diagnostics. There are medical device companies trading at 15 to 18 times earnings. These are high-quality businesses with strong competitive positions and good growth prospects. Why am I bullish on these companies right now? Because we're coming out of a period where healthcare utilization was depressed during and after COVID. People deferred elective surgeries. They put off going to the doctor. Now that's normalizing. People are catching up on the medical procedures they deferred. This is driving volume growth for medical device companies. Also, there's enormous innovation happening in medical devices. Robotic surgery systems are becoming more advanced and more widely adopted. Minimally invasive procedures are replacing traditional surgeries. Diagnostic devices are becoming more sophisticated. All of this creates growth opportunities for the leading medical device companies. So we have pharmaceutical companies and medical device companies with strong fundamentals, growing markets, durable competitive advantages, and reasonable valuations. Why is December of 2025 the last chance to buy these stocks? Because as interest rates fall, defensive stocks like healthcare become more attractive. Healthcare stocks are considered defensive because people need healthcare regardless of the economic environment. When interest rates are high, investors prefer offensive stocks that can grow rapidly. When rates fall and economic uncertainty increases, investors shift to defensive stocks. Also, the political risk around drug pricing is diminishing. We've had years of talk about government price controls on drugs, but the actual policies that have been implemented have been relatively modest. The market is starting to realize that the worst case scenarios aren't going to happen. Pharmaceutical companies will continue to be able to price their drugs profitably. As this recognition spreads, healthcare stocks will re-rate higher. A pharmaceutical company trading at 13 times earnings could easily trade at 17 or 18 times earnings, which is still below historical averages. That's a 30 to 40% gain. Plus you're collecting a 3 to 4% dividend. The fourth and final area where I'm seeing compelling value is in certain consumer staple companies. These are companies that make products people use every day regardless of the economic environment. Think food and beverage. Companies, household products, personal care products, consumer staple companies have been out of favor because they're perceived as boring. They don't grow rapidly. They're not exciting. Money has flowed out of these stocks and into technology. This has created opportunities. There are consumer staple companies with iconic brands trading at 16 to 20 times earnings. Now, 16 to 20 times earnings might not sound cheap. It's not as cheap as the banks at 9 times or the oil companies at 6 times. But for consumer staple companies, this is reasonable. These are businesses that generate high returns on capital, that have pricing power, that grow steadily even in recessions. Historically, they've traded at 20 to 25 times earnings. So at 16 to 20 times, they're somewhat undervalued. Why do I like consumer staples right now? Because they're incredibly durable businesses. People will keep buying Coca-Cola, Tide detergent, Gillette razors, Snickers, bars, regardless of what's happening in the economy. These products are ingrained in consumers' lives. The brands are powerful, and the companies have pricing power. When costs go up, they can raise prices without losing significant volume. Let me describe the characteristics I look for in consumer staple companies. I want companies with multiple strong brands, not just one. Procter & Gamble has Tide, Pampers, Gillette, Crest, and many others. If one brand struggles, the others compensate. I want companies with pricing power. The best consumer staple companies can raise prices over time to keep up with inflation and maintain profit margins. I want companies with global reach. The growth opportunities are in developing countries where rising incomes lead to increased consumption of branded products. And I want companies with efficient operations and high profit margins. These characteristics create businesses that can compound value for decades. They're not going to double in a year, but they'll steadily increase earnings, steadily raise dividends, and steadily create value for patient shareholders. Why is December of 2025 critical for consumer staples? Because as interest rates fall, yield-oriented investors will return to dividend-paying consumer staple stocks. These companies typically yield 2 to 3%. When cash yields 5%, it's not attractive. But when cash yields 2 or 3%, suddenly a stable company with a growing 2 to 3% dividend yield looks appealing. Also, consumer staple companies have largely worked through the cost inflation that hit them in 2022 and 2023. Their profit margins are recovering, earnings growth is accelerating, and the market will start to recognize this. Now, let me tie this all together and explain why you need to act in December of 2025. I've identified 4 areas where extraordinary value exists. Regional banks trading at 8 to 12 times earnings, integrated oil companies trading at 6 to 8 times earnings, healthcare companies trading at 12 to 18 times earnings, and consumer staple companies trading at 16 to 20 times earnings. In all 4 cases, these valuations are below historical averages. In some cases, significantly below. And in all 4 cases, the fundamentals are strong or improving. So why haven't the stock prices adjusted yet? Because the market has been obsessed with a handful of mega cap technology stocks. Because fear from the banking crisis of 2023 still lingers. Because ESG mandates have pushed money away from energy. Because investors chase growth and ignore value. But this is changing. The factors I described at the beginning, falling interest rates, strengthening economy, pockets of undervaluation, are creating a shift. Money is starting to move from the overvalued sectors to the undervalued sectors. It's a slow process, but it's happening. And once it accelerates, these opportunities will disappear quickly. I've seen this pattern many times throughout my career. There's a period where certain sectors become overvalued and other sectors become undervalued. This can persist for a year or 2 or even longer. But eventually, the market corrects, value is recognized, prices adjust, and the opportunity is gone. We're at that inflection point right now. The opportunity still exists in December of 2025, but I don't believe it'll exist much longer. By mid-2026, I expect that regional banks will be trading at 14 to 16 times earnings, not 9. Oil companies will be trading at 9 to 11 times earnings, not 6. Healthcare companies will be trading at 17 to 20 times earnings, not 13. And consumer staples will be trading at 22 to 25 times earnings, not 17. When that happens, the easy money will have been made. The stocks will still be good businesses. They'll still be worth owning, but they won't be dramatically undervalued anymore. The opportunity to buy at truly cheap prices will be gone. So what should you do? If you have capital available to invest, I would strongly consider allocating it to these 4 areas. Build a diversified portfolio across regional banks, energy companies, healthcare companies, and consumer staples. Don't try to time the exact bottom. Don't wait for prices to fall further. Buy now while these valuations still exist. And then be patient. Hold for at least 3 to 5 years. Let the fundamentals play out. Let the market recognize the value. Let the companies compound. I also want to address what could go wrong, because I'm not someone who promises that investments are risk-free. What are the risks for regional banks? The risk is that the economy falls into recession and loan defaults spike. I don't think that's likely given current economic strength, but it's possible. For energy companies, the risk is that oil prices collapse if demand falls or supply surges. Again, I don't think that's likely, but it's a risk. For healthcare companies, the risk is that government price controls are more severe than expected, or that pipeline drugs fail in clinical trials. For consumer staples, the risk is that consumers trade down to cheaper brands if the economy weakens. These are real risks. I'm not dismissing them. But in my judgment, the probability-weighted outcomes are heavily skewed to the upside. The potential gains significantly outweigh the potential losses. And that's what investing is about. It's not about finding risk-free investments. It's about finding situations where the odds are strongly in your favor. Right now, in these four areas, the odds are strongly in your favor. Let me close with this thought. I'm 94 years old as I record this in December of 2025. I've been investing for over 80 years. I've lived through every market cycle imaginable. Bull markets, bear markets, crashes, booms, recessions, expansions. I've seen everything. And I can tell you with confidence that moments like this, where multiple high-quality investments are available at genuinely cheap prices, don't come along often, maybe once every 10 or 15 years. The last time I felt this way was in 2008 and 2009 during the financial crisis. The time before that was probably in the late 1970s and early 1980s. And the time before that was in the 1970s. Each time, investors who had the courage and conviction to buy when others were fearful made extraordinary returns over the following years. This is that kind of moment. December of 2025 is your opportunity to buy quality businesses at valuations that won't last. Regional banks at 9 times earnings, oil companies at 6 times earnings, healthcare companies at 13 times earnings, consumer staples at 17 times earnings. But before you act, let me give you more specific guidance on how to implement this strategy, because the details matter enormously. Let me start by walking you through exactly how to evaluate regional banks. Because not all banks are created equal. There are good banks and bad banks. And if you buy the wrong ones, you'll lose money even if the sector does well overall. So here's what I look for. First, the loan portfolio composition. I want to see a diversified loan book. A good regional bank should have a mix of commercial loans, residential mortgages, commercial real estate loans, and consumer loans. If any one category is more than 40% of the total loan book, that's a red flag. It means they're too concentrated. I'm especially cautious about banks with heavy exposure to commercial real estate, particularly office buildings. The office sector is under pressure from remote work trends. Buildings that were 95% occupied in 2019 are now 60% occupied. Landlords can't make their mortgage payments. Loans are defaulting. So if a bank has 30 or 40% of their loan book in commercial real estate, especially office properties, I avoid them. That's a problem waiting to happen. Second, I look at deposit composition and stability. The best banks have deposits that are sticky. What makes deposits sticky? Small business checking accounts, consumer checking accounts, where people have direct deposit and automatic bill payments set up. These deposits don't leave when interest rates change because they're operational. People need their checking accounts to run their lives and businesses. The worst deposits are large uninsured deposits from venture capital firms or crypto companies or hot money that's just chasing yield. Those deposits will flee at the first sign of trouble. So I study the deposit base carefully. I want to see that at least 70 to 80% of deposits are under the FDIC insurance limit of $250,000. Those are fully insured and safe. I want to see that deposits come from a diversified base of customers, not concentrated in any one industry or customer type. And I want to see that deposit balances have been stable or growing, not shrinking. If deposits are shrinking, that's a warning sign that customers are losing confidence in the bank. Third, I examine the bond portfolio. During the low interest rate period from 2008 through 2021, banks bought a lot of long-term bonds. These bonds paid 2 or 3%. Then when interest rates rose sharply in 2022 and 2023, the value of those bonds fell dramatically. A bond that pays 2% is worth much less when new bonds are paying 5%. This created unrealized losses on bank bond portfolios. For some banks, these losses were so large that they wiped out all the bank's capital. That's what happened to Silicon Valley Bank. So I need to understand the bond portfolio. How long's the duration? Longer. Duration means more interest rate sensitivity. How large are the unrealized losses? If they're small relative to capital, no problem. If they're large, that's a risk. And importantly, does the bank have enough liquidity to hold these bonds to maturity? If they're forced to sell bonds at a loss to raise cash that destroys capital, but if they can hold the bonds and collect interest until maturity, the unrealized losses don't matter. They'll get their money back at par value when the bonds mature. Fourth, I look at capital ratios. Banks are leveraged businesses. They borrow money from depositors and lend it to borrowers. The difference between what they pay depositors and what they charge borrowers is their profit margin. But leverage is dangerous if things go wrong. If loans default and the bank loses money, that loss comes out of capital. If capital is wiped out, the bank fails. So I want to see strong capital ratios. The regulatory minimum for a well-capitalized bank is about 10% common equity Tier 1 capital. I prefer to see 12 to 14% or higher. That extra cushion means the bank can absorb losses without getting in trouble. Banks with strong capital can also return more cash to shareholders through dividends and buybacks because they don't need to retain as much earnings to maintain capital ratios. Fifth, I evaluate management quality and track record. Banking is a relationship business. Good management knows their customers. They underwrite loans conservatively. They don't chase growth at the expense of credit quality. They maintain discipline during boom times when everyone else is loosening standards. I look at the bank's credit performance over multiple economic cycles. Did they have high loan losses during the 2008 crisis, during the COVID recession? If they came through those periods with relatively low losses, that tells me management is disciplined and conservative. If they had massive losses, that tells me they take too much risk. Now, when I put all these criteria together, I find that there are maybe 20 to 30 regional banks out of hundreds that meet my standards. The ones that pass this screen are truly high-quality institutions that are dramatically undervalued at current prices. And here's the key insight. When the sector turns and investors start buying regional banks again, money will flow disproportionately to the highest quality banks. The weak banks will struggle. Some might fail, but the strong banks will thrive. Their stock prices will recover strongly. This is why selectivity matters so much. You can't just buy a regional bank ETF and hope for the best. You need to identify the best individual banks. Now, let me talk about how to evaluate energy companies, because this sector also requires careful analysis. The energy business is cyclical and capital intensive. Companies that look healthy at $90, oil can be in trouble at $50 oil. So I need to understand the economics at different price levels. First, I look at the cost structure. What does it cost this company to find and produce oil? The best companies have production costs in the $30 to $40 per barrel range. That means they're profitable even in a severe downturn when oil prices crash. Other companies have costs of $60 or $70 per barrel. They're only profitable when oil prices are high. I want the low-cost producers. How do you determine cost structure? You read the company's presentations to investors. They usually disclose their all-in costs per barrel, including finding costs, development costs, lifting costs, and corporate overhead. Compare those numbers across companies. The ones with the lowest costs have a major competitive advantage. Second, I examine the reserve base. Oil and gas. Companies own reserves, which are the oil and gas still in the ground that they have rights to produce. Reserves are categorized as proven, probable, or possible based on the certainty that they can be economically recovered. I focus on proven reserves. How many years of production do they have at current production rates? I want to see at least 10 years, preferably 15 or 20. This tells me the company has a long runway before they need to find new reserves. I also look at the quality of the reserves. Are they in easy to access locations with good infrastructure? Or are they in difficult deep water or Arctic environments that are expensive to develop? The higher quality reserves generate better returns. Third, I assess the balance sheet and financial flexibility. The energy business is volatile. Oil prices swing dramatically. Companies need strong balance sheets to survive the down cycles. I look at debt levels relative to cash flow. A good rule of thumb is that debt should be less than 2 times EBITDA. Companies with debt ratios higher than that are vulnerable if oil prices fall. I also look at liquidity. How much cash does the company have? Do they have undrawn credit lines they can access if needed? Companies with strong balance sheets can not only survive downturns, they can thrive by acquiring assets from weaker competitors who are forced to sell. Fourth, I examine capital allocation. Discipline. The best energy companies generate huge amounts of free cash flow, and they're disciplined about how they use it. They don't reinvest every dollar back into drilling more wells. They return a substantial portion to shareholders through dividends and buybacks. Why is this important? Because historically, energy companies destroyed value by overdeveloping during boom times. They would drill too many wells. This would increase supply, which would push oil prices down, which would hurt returns. It was a self-defeating cycle. The best companies today have learned from those mistakes. They maintain capital, discipline, they limit production growth, they focus on returns rather than volume, and they return cash to shareholders. This creates a much better investment outcome. Look for companies that are returning at least 50% of free cash flow to shareholders. Some are returning 70 or 80%. Those are the ones I'm most interested in. Fifth, I consider the refining and chemical businesses for integrated companies. Some energy companies are purely upstream producers. Others have downstream refining and chemical operations. I prefer the integrated companies because they provide some diversification. When oil prices are high, upstream is very profitable, but refining margins can be squeezed because input costs are high. When oil prices are low, upstream is less profitable, but refining margins often expand because crude oil is cheap. Over a full cycle, this integration provides more stable earnings than pure upstream companies. The refining business also generates consistent cash flow because refiners earn a margin on every barrel they process, regardless of the absolute price of oil. And when I apply these criteria, I find that there are a handful of integrated energy companies that are truly excellent businesses, trading at absurdly low valuations. These are companies that will generate enormous free cash flows at current oil prices. They'll return that cash to shareholders, and over 5 or 10 years, they'll create tremendous value. Now, let me give you more detail on healthcare stocks because this is a complex sector with many subsegments. When I talk about healthcare, I'm primarily focused on 3 types of companies. Large pharmaceutical companies, often called big pharma, medical device companies, and healthcare services companies like pharmacy benefit managers or distributors. Let me address each one. For pharmaceutical companies, the key is understanding the patent expiration timeline and the pipeline of new drugs. Every pharmaceutical company has a portfolio of drugs at different stages of their life cycle. Some drugs are newly launched and ramping up sales. Some are at peak sales. Some are facing patent expiration soon. And the company has drugs in development that haven't launched yet. The art of evaluating a pharmaceutical company is projecting how these different forces will net out over time. You need to estimate how much revenue the company will lose as patents expire, then estimate how much revenue they'll gain from new drug launches. If the new drugs more than offset the patent expirations, earnings will grow. If not, earnings will decline. How do you make these estimates? You study each major drug. When does the patent expire? How much revenue does it generate? How fast will sales decline after patent expiration? Most drugs lose 70 to 90% of their revenue within a year or two after generic competition enters. So if a drug generating $5 billion per year goes off patent, you should expect that revenue to fall to $1 billion or less fairly quickly. Then you study the pipeline. What drugs are in phase 3 clinical trials? These are the closest to approval. What's the probability of success? For phase 3 drugs, the probability of eventual approval is about 60 to 70% on average. Though it varies by therapeutic area, what's the potential market size if the drug is approved? A drug for a rare disease might only generate a few $100 million per year. A drug for a common disease like diabetes or heart disease could generate several billion per year. You build a model projecting all of this out 5 or 10 years. If your model shows that earnings will grow and the stock is trading at a reasonable multiple of those future earnings, that's an interesting investment. Now, I'm not a scientist. I can't evaluate whether a drug will work or not, but I can evaluate the business model, the financial position, the track record of management, and the overall portfolio of drugs and pipeline. I look for companies with diversified portfolios, so they're not dependent on one or two drugs. I look for companies with strong balance sheets and high margins, so they can afford to invest in research and development. And I look for companies with good historical track records of bringing new drugs to market. There are pharmaceutical companies that meet these criteria, trading at 12 to 15 times earnings. Given the growth potential and the stability of the healthcare market, that's attractive. For medical device companies, the analysis is somewhat simpler. These companies don't face the same patent cliff risk because devices are protected by multiple patents, trade secrets, and regulatory barriers rather than one key patent. And devices are often procedure-based. Once a surgeon is trained on a particular device or system, they're sticky. They don't want to switch. I look for medical device companies with leading market positions in their categories. The number 1 or number 2 player in a market usually has strong profitability and competitive advantages. I look for companies with high switching costs, surgical systems where the surgeon needs training, implants where the hospital has standardized on that system. These create durable moats. I look for companies benefiting from favorable demographics and healthcare trends. Aging populations need more joint replacements, more cardiac procedures, more surgeries. Minimally invasive techniques are replacing traditional open surgeries. These trends provide growth tailwinds, and I look for companies with international growth opportunities. Many medical device companies generate most of their revenue in the United States, but the growth opportunities are in Europe, Asia, and Latin America, where healthcare spending is increasing as incomes rise. Companies that are successfully expanding internationally have long runways for growth. When I find medical device companies with these characteristics trading at 15 to 18 times earnings, that's reasonable value for quality businesses. Finally, let me talk about healthcare services companies. These include pharmacy benefit managers like CVS Health's Caremark division, wholesale drug distributors like McKesson and Cardi, Nal Health, and retail pharmacy chains like Walgreens. These are not as exciting as drug companies developing new therapies, but they provide essential services in the healthcare system. They have stable, recurring revenue, and they're trading at very low valuations. Pharmacy benefit managers act as intermediaries between drug manufacturers, pharmacies, and insurance companies. They negotiate drug prices, they process claims, they manage formularies. It's a complex business, but it generates steady cash flow. The companies are trading at low valuations because of political concerns about their role in drug pricing. But the business model is more durable than people think. Wholesale distributors buy drugs from manufacturers and distribute them to pharmacies and hospitals. They earn a small margin on each transaction. It's a low margin, high volume business. But it's essential. Every drug that gets prescribed needs to get from the manufacturer to the patient. Distributors provide that infrastructure. These companies are also trading at low valuations, below 10 times earnings in some cases. For businesses that are essential, infrastructure with steady cash flows, that's cheap. Retail pharmacies are more challenged because of pricing pressure and competition from mail order and online pharmacies. But the best chains are adapting. They're adding healthcare services like vaccinations and health clinics. They're improving their digital offerings, and they're trading at very low valuations that reflect a lot of pessimism. Across all these healthcare segments, I'm seeing opportunities to buy quality businesses at reasonable to cheap prices. The sector has been out of favor. Political concerns have created uncertainty, but the fundamentals are strong. Healthcare spending continues to grow. The companies are profitable, and the valuations are attractive. Now, let me give you more detail on consumer staples, because this is another area where selectivity matters. Not all consumer staple companies are good investments. Some face secular headwinds. Private label brands are taking share from branded products in many categories. E-commerce is disrupting traditional retail channels. Changing consumer preferences, like the shift toward healthier foods, are hurting some legacy brands. So I need to identify the consumer staple companies that have durable competitive advantages and are well positioned for the future. What do I look for? First, strong brands with pricing power. The best consumer staple companies own brands that consumers love and will pay a premium for. Coca-Cola, Tide, Gillette, Snickers. These brands have been around for decades. They have enormous brand equity. When costs go up, these companies can raise prices and consumers keep buying. Companies with weak brands can't do this. They're stuck competing on price against private label. That's a much tougher business. Second, diversification across multiple categories and geographies. A company with one brand is vulnerable. If consumer preferences shift away from that brand, the whole business suffers. But a company with dozens of brands across different categories is resilient. If one brand struggles, others compensate. Similarly, companies with global operations are less dependent on any one market. Procter and Gamble sells products in over 180 countries. If the U.S. economy slows growth in China or India or Latin America, can offset it. Third, consistent innovation and product development. The best consumer staple companies don't just sit on their legacy brands. They innovate, they improve products, they launch new variants, they adapt to changing consumer preferences. Tide isn't the same product it was 30 years ago. P&G has continuously improved the formula, added scent options, created pods for convenience. This keeps the brand fresh and relevant. Fourth, efficient operations and strong margins. Consumer staple companies are generally high margin businesses. Gross margins of 50 to 60% are common for branded products. Operating margins of 15 to 25%. These high margins provide cushion to invest in marketing, innovation, and acquisitions. They also provide flexibility to manage through periods of cost inflation. Companies with strong margins can absorb some cost increases without destroying profitability. Fifth, shareholder-friendly capital allocation. The best consumer staple companies generate more cash than they need to reinvest in the business. They return that cash to shareholders through dividends and buybacks. Most pay dividends of 2 to 3% and grow those dividends steadily year after year. They also buy back stock opportunistically when valuations are attractive. When I apply these criteria, I identify maybe 15 to 20 consumer staple companies that are truly high quality, and several of them are trading at attractive valuations right now. They're not as cheap as the banks or energy companies, but for steady compounding machines that will deliver consistent returns for decades, they're reasonably priced. Now, let me address the question of how much to allocate to each of these four areas. This depends on your age, your risk tolerance, and your overall financial situation. But let me give you some guidelines. If you're younger, say in your 30s or 40s, and you have a long investment horizon, I'd be more aggressive, maybe 40% in regional banks and energy companies where the valuations are most attractive and the upside is largest. 30% in healthcare where you get a nice balance of value and growth, and 30% in consumer staples for stability. If you're older, approaching retirement, or already retired, I'd be more conservative. Maybe 25% in banks and energy, 40% in healthcare, and 35% in consumer staples. This tilts toward the more defensive sectors that will generate steady income through dividends. Within each sector, I diversify across multiple companies. Don't put all your regional bank exposure in one bank. Own 3 or 4 high-quality banks. Don't put all your energy exposure in one company. Own 2 or 3 integrated oil companies. This way, if you're wrong about one specific company, it doesn't devastate your portfolio. Let me also talk about timing and implementation. I'm saying December of 2025 is the last chance to buy these stocks at current prices. But that doesn't mean you should invest everything on one day. Markets are volatile. Stock prices bounce around. If you invest everything at once and stocks drop 10% next week, you'll feel terrible. A better approach is to invest systematically over the next few weeks or months. Maybe you invest 1/3 of your capital in December, another third in January, the final third in February. This way, you're averaging into positions. You'll get some shares at lower prices, some at higher prices. Over time, it evens out, and you avoid the psychological pain of buying everything at what turns out to be a short-term peak. Another approach is to set target prices. Identify the stocks you want to own, calculate what you think they're worth, then place limit orders to buy at prices below current levels. If the stocks dip, you get filled. If they don't, you'll buy at market eventually. Now let me address a critical point about patience. I'm telling you that December of 2025 is the last chance to buy these stocks at current prices. And I believe that. I think that by late 2026, these opportunities will be gone. But that doesn't mean the stocks will go straight up starting in January. Markets are volatile. These stocks could drop 20% before they rise 50%. That's normal. You need to be prepared for that volatility. If you buy a regional bank today and it drops 15% over the next 2 months, that doesn't mean you made a mistake. It means the market is noisy in the short term. If the fundamentals are intact, if the thesis is still valid, those short-term declines are opportunities to buy more, not reasons to panic and sell. This is where most investors fail. They buy stocks based on a long-term thesis. Then the stocks drop 10 or 20%, and they panic. They sell at a loss. They abandon the thesis right before it starts working. Don't do that. If you're going to invest in these sectors, commit to holding for at least 3 years, give the thesis time to play out, let the fundamentals manifest in the stock price. That's how you build wealth in the stock market. Let me share one final thought. Throughout my career, I've made money in many different ways. I've bought undervalued companies and held them until the market recognized their value. I bought great businesses at fair prices and let them compound for decades. I bought distressed securities during crises when everyone else was selling. But the common thread through all my successful investments is that I was buying when others were fearful or indifferent. I was buying what was unloved and undervalued. I was patient enough to wait for the market to come around. That's exactly what I'm describing today. Regional banks are unloved because of the 2023 crisis. Energy is unloved because of ESG and energy transition fears. Healthcare is unloved because of political concerns. Consumer staples are unloved because they're boring. But unloved doesn't mean bad. In fact, unloved often means opportunity. When nobody wants something, that's usually when it's cheapest. And when something is cheap, patient investors who buy and hold can make extraordinary returns. 5 years from now, you'll look back at December of 2025, and you'll remember that this was when these opportunities were available. The question is whether you'll have taken advantage of them. Don't let fear or indecision or the need for perfect information stop you from acting. The opportunity is here. The valuations are attractive. The fundamentals are sound. All you need to do is act. Buy these stocks in December of 2025. Hold them patiently and let the market recognize their value over the next few years. That's how you build wealth in the stock market. That's what I've done for 80 years. And that's what I'm urging you to do right now.